Hi, and welcome back to the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at EU.VC. This is a special EUVC episode straight from the Engage Investments conference in Prague, hosted by our friends from Depo Ventures. Shout out to Petr, who was kind enough to invite us. This is the recording of the panel Perspective of LPs and VCs on the current market situation. This panel had the participation of our hosts Andreas and David, Ondrej, General Partner at Credo Ventures, Vuk, Venture Capitalist at RSJ Investments, Michal, Managing Partner at Depo Ventures, and Michael, Principal at VentureFriends. If you enjoy our content, do support us by hitting the follow button, giving us a review, and following the European VC on LinkedIn.
Perspectives of LPs and VCs on the current market situation. I think we've been to a bit, all of us almost probably been to quite a bit of events over the last 4 or 6 months where we've every single time been talking about the same thing, meaning the current market and what's going on. So for that reason, I'll try and maybe not focus too much on what is going on, but rather dive directly into what is going to happen. Because I feel like we've been, and obviously you guys are going to provide a bit of context and tell us what that's needed probably, but I don't want us to be going through 30 minutes of what is just going on, right? So let's rather dive right into it, and I'll ask you, Ondrej, to be the first, and just tell us a bit about how you have adapted your thinking inside Credo to the current market situation, and in that, of course, bring the context and tell us, we saw this, now we're doing this.
But that's difficult.
Sorry.
Can I talk about diversity instead?
Yeah, sure.
Diversity is great.
Yeah, as you see, our panel is very well represented.
Jokes aside, good afternoon, everybody. I think the fair answer is I try to adapt every day. Every day is a bit different. Have we adapted? We're trying to be adaptive because it's not that the market's changed. The market has been changing, and it still is. So I guess the question is whether we've managed to adapt to the ever-changing, rapidly changing market. And the fair answer is no. We're still trying.
Yeah.
I think so. You mentioned earlier that just today we announced our Fund 4 of 75 million euros. No, I'm not saying that. But so we actually went from, our Fund 3 was almost 100 million, 97. We went down to 75. And many people in the last couple of days have been asking me if that was the reaction to the changed market, the changed situation. And the fair answer there is no. That's how we wanted it already when we designed our fund back at the end of 2021. But am I happy that we went a little smaller? Yes, I am. In this ever-changing market situation, I am super happy that we kept it small because it's more adaptive. It allows us to be more scrappy and yeah.
But I do think, I would love to dive into it a bit and we'll come to you guys. But sorry, I just think that it's so interesting to see you going to 100 and then going back down. And as you said just before we went, we wanted to go to 60, but then there was a bit, we ended up in 75. In our podcast, we've spoken to many over the last, year where all of them were raising bigger and bigger funds and we're deploying more and more. How did you keep your head in the boom, and then after it's also in the bust?
I'm trying to think about a way how to put it, not looking like a douchebag, right? But I guess the fair answer is we just really, we felt the temptation of going larger and larger, and we managed to resist this temptation because what we really want to do is we want to do pre-seed and seed rounds. We don't want to go upstream doing more Series A, analyzing more numbers, because we're not number crunchers at Credo, right? So that's one. Then there was this temptation of going broader, like, going to the Baltics or Turkey or Western Europe or global.
Yeah.
And we didn't want to do it either. Like we love our region. We spent over a decade building, connections and networks in the region, looking for talent. We feel like we had really good access here. So we wanted to double down on this region. And we felt like, 60 to 75 was the right size. And actually, if you want to hear it between you and me, we kind of felt the 100 was a bit too much.
Yeah.
So, we might have made a mistake with the 100, but like too big.
Yeah.
No, I'm kidding. It was good.
Vuk, I think, if I'm not wrong, I think you were also in the press release. Actually, RSJ was in the press release on Credo. Yeah, so
we have we always include them in the it's a paid partnership.
Yeah.
Literally, yeah.
No, but so you've also been going through the same thing as all of us. I'd love to hear, let's take Credo's, development, going to 100 and then down to 60. How were you thinking about that? How did you react when Credo came back and said, we're actually going to go to 60 this time? Like, what?
Yeah, so it was the only fund that we saw out there who did that, a year ago. Now we saw a couple of more as we went into 2022. But from our perspective, it really made sense, not from perspective of the fund size, to be correct, but rather than, when they came to us and said, like, we are really going to focus on what we, know how to do, what we really like, and that's what we appreciated. And, as mentioned, there are not a lot of teams that did that, especially at that time of the cycle.
Yeah. Let's stick with the fund size topic for a bit, and I'll now shift to you, Michal. How have you thought inside of Depo about fund size, because you're now putting together your fund 3. Has it been, a subject for you? How big should we go? Or has it just been clear all the way that we're sticking to this? And I think for anyone, typically in VC, we say that your fund size is your strategy. So that's why it's really worthwhile to be thinking very much about this part, right? So tell us how you've been thinking through it.
I think our position is a bit different because we are going bottom up. So we are going from the angels who are giving startups like 10, 20K and co-investing with others to the level where we are able to invest as a fund itself. So now we were able to invest 100K in startups, in pre-seed startups. And our goal, because we see the market trends and very good deal flow and everything, and we see that founders we want to have more strategic role in our portfolio companies, and not only that, we want to provide them with the follow-ons. We weren't able to do it now.
So you've been catching up.
Yeah. So our roles are a bit different. But I think we can meet Credo somewhere in the middle.
So, Michael, tell me, at VentureFriends, you are a global investor. That means that you have seen the market go, very quick in Silicon Valley a bit. Then we're seeing the same stuff happen in Europe, 3 months, 4 months delay. How have you gone through this period and then now to where you are now?
Yes, so for us, being more than European investors, because we also invest in Middle East and Latin America, it's a bit different consideration in terms of fund size. So we can stick to our 100 million fund without sacrificing on quality, because we just have the bigger scope of where we are exposed. But in terms of characteristics and the ways that the markets have behaved in LATAM, Middle East, and Eastern Europe or Southern Europe, I think it's not that different in a way. I think it's mostly consideration of developed versus emerging VC markets. So I think many of the things that we see also in MENA or in Southern Europe, for example, it's similar characteristics. So it's kind of lagging effect compared to US and Western Europe. And I think the magnitude of impact is slightly lower, to be honest, because there is much more activity in the earlier stages. So where the impact is much less pronounced as opposed to later stage pre-IPO, where the impact is much heavier. So I would argue it's similar, roughly, everywhere.
Okay, so now I have a question which is also it's actually very much in the fund size realm, because I'm also going to ask you about deployment rates, and I'm going to start with our two LPs on the panel here, and ask you, you're seeing funds both, increasing fund size, then you're seeing, some, also increasing. If they don't increase fund size, then they just increase deployment rate, meaning that, they might still have a 50 million euro fund, but they just kick it out over 2 years instead of 3. What did you see? What type of behavior on the deployment rate did you see? And thinking retroactively, and I also ask the rest of you to think and talk honestly to me here, how did you act during the period? Did you send out a bit more money, a bit more quickly than you used to, and maybe would say, I'm happy that I have? I spoke very honestly with some LPs, but did you really ask or talk to your VCs about your deployment rate? Are you maybe a bit, being overactive in this market? and some of them said very bluntly, I don't actually think that I spoke enough to my VCs about that. I wasn't critical enough of the times we were in. But I'd love to hear what you think, Vuk.
Yeah, sure. So for us, the situation is slightly different in the sense that we do not do that many fund investments in one of our vintages. So we are not the type of investor who would do 20, 30 fund investment in one of our portfolio. So we had kind of constrained view on our VC funds that we have partnered with. So in a sense, yes, we saw that deployment rate was high. Not in each and every VC, and that is also a part that we challenged people when they came back to us early this year to raise the next vintage. And it really depends on the strategy of VC, what he's looking, whether he invests in very hype deals or not, whether they invest into slightly overlooked markets, etc. In first case, of course, we saw funds which were deployed in 18 months, so some earlier. That kind of behavior, is considered risky. Whether we were challenging them enough, I would agree with what you have mentioned. It's connected to a thing that was just going on in the VC space and in the tech ecosystem at all. For example, I personally thought that this is it. We are going for this. This will last forever, and technology is there, and we're going to do that. Yeah. But on the other hand, I also as an LP, I'm more conservative in a sense. So there was just. I would say that it was just somewhere in the middle. I did challenge people, but with a position of 5 to 10% in the fund, you not anchoring the fund. It's also
yeah, you are a limited partner, right? Yeah, so that's what we spoke about earlier. Limited. There's a reason why it's called limited partner. But still, you're typically also in an LPAC, or at least you have the ear of the GP, and they take you because you've got advice that's hopefully worthwhile. So even though you don't have a table to stamp in. David, tell me a bit what you've been thinking. We've spoken to many emerging managers that had quite rapid rates in their thinking.
The honest answer is I have no fucking clue. I really don't know. We found ourselves, and being really transparent, I found myself earlier this year getting really excited about these super fast deployment rates, and we talked about that. And now kind of coming back, talking with much more experienced LPs about that topic, is vintage diversification that relevant or not? You deploying a fund in 18 months, is that wise? Isn't that? So I honestly don't know, but I tend to feel, and I don't have data points for this, but I tend to feel that when you're doing early stage, like we are, and most people in this room are, I actually think it's less relevant the more I think about it. Because I just think it's about a bump in the road, right? I think the market over time will correct itself as well, both positive and negative. And so I think vintage diversification might be overrated, but the honest answer is I don't fucking know.
I'm sure Vuk has some thoughts here. So now I asked the question to the two LP guys about what did you say to your GPs. Now I'll ask you as the VC guys, because I thought that, hitting March, then you had all the VCs going out there saying, you need to be adjusting burn rate. And then they had a 14-page document on how to adjust to a crisis and think about profitability and think about burn rate and that kind of thing. And then you're like, well, that's very far from what you were preaching just, 3 LinkedIn posts back. So I'm curious to hear, do you think that you were, acting in, I'd say maybe conservative enough in the boom days of before February?
Yeah, I think when I tide goes away, you can see who's been swimming naked. And you can see very graphically now who has. Yeah. And I think for many companies and many portfolios who are on the more prudent side, they have been disadvantaged for the last few years. So we've had companies which were growing slightly slower than their competitors, but being unit economics positive and growing in a more sustainable way on the product side. And now, when the tides has shifted, we see that some competitors go out of business, some are struggling to raise, whereas the unit economics suddenly start to matter. And I think I'm on the side that actually what has happened to the markets is going to be in a midterm, for sure not in the short term, but in the midterm to long term, it's going to be positive for the overall mindsets and the ways that that VCs thinks about deployment, and also the founders thinks about growth and sustainability of their of the business models.
Yeah. Who wants to go here?
I don't know. I'm thinking. First of all, I just thought of a really great comment on diversity in the naked swim-in, but this is not the diversity panel, so let's not go there. For some reason, 2021 was not a great year for us in terms of new investments. Oh. And I would love to say that was a conscious decision on our part and we were being, diligent and smart about it, but that would not be true. For some reason, Q2, Q3, 2021, we just didn't have good pipeline. I don't understand. And most of the guys that we spoke with in the US and in Western Europe were like, dude, those are busy times. We're investing left and right. And we were like, yeah, we are too. But the truth was, our pipeline was not great. And the past 6 months, ever since we had a secret first closing of our Fund 4, we've made 10 investments already, and we have 2 more approved, which is 12 for 9 months. No, 6 months, which is really fast. Yeah. And it's not a function of the market. It's just a function of good pipeline that we happen to have the past 6 months. So I guess what I'm trying to say is we try to be as detached from the cycle when making new investments. Yeah. And like at the peak times, that were great. I still remember the glorious 2021. We did make some overpriced investment, I'm sure. Yeah. And we did invest after, very limited due diligence, which is the euphemism of no due diligence. And we now have a lot more time to spend on the investment cases. But other than that, I am much more driven by, the cases, the pipeline, the quality of potential deals we're looking at than the cycle. We try to be detached as much as possible.
Yeah. But if I could add one thing, if I might, what I'm very skeptic about is emerging fund managers whose whole unfair advantage was speed. Yeah. That I'm very skeptical about. If that is the underlying building block of your unfair advantage, as markets shift and go back and forth, speed becomes either something that you want or something that you don't want, right? Yeah. That is where I'm skeptic, and that is where I feel, well, if that's the only thing you bring to the table, you're actually not needed this year, right?
Yeah, and I actually think I haven't thought about that before, but I guess Vuk, that's also something you've seen with all, you like emerging managers and you like small managers. Definitely. And for sure, we saw a lot of pitch decks that said from solo GPs, we act quick.
Yeah, definitely. I mean, we saw that, but in general, our numbers in our pipeline were really high. So we saw really lots of funds like during the last year, especially in emerging manager part of it. But the teams varied really a lot. Whether someone is specialized, has been working on it really, for quite some time, quite a few years, wanted to get into a VC, and now he had a good time to finally raise the funds. So we saw that, like that example. But we also saw people who just were riding the wave. I mean, also the second strategy can earn them a lot of money. We will see about it, but definitely we preferred the first one, and we also created a separate strategy for that.
Yeah, I think also I don't have data set to back it up, but I think there is a tendency of speed being also correlated with being very price insensitive. So if you combine the two and the emerging manager, and the cycle, of course, because if everything goes up, I mean, there is no check type of situation, then it's a recipe for disaster from the LP perspective. Not in all cases, but obviously the risk-return profile is not as favorable as otherwise. So I think it's not about just the speed, but also price flexibility, so to speak.
Yeah.
Nah, but to that
Unless the cycle changes. Like, oh, come on. You know, in the fall now.
you never know.
You never know.
No, but I was just going to say, not to be misinterpreted with being highly specialized, thus you can move quick in this sector. That is different, right? Yeah. I'm just talking about like pure speed being the differentiating factor, because then it leads to exactly what you said. But if you're the only guy or one of the few guys or girls that really understands biotech drug development, well, then yes, you can be quick, but you know what you're doing, right? That's but a little caveat there.
I'm thinking about our investment strategy, and as I like running,
You like speed?
No. I like to have the same pace, and we set in our strategy that we are ready to invest in 15 portfolio companies per year, and we are sticking to this goal across our two funds. So basically, my answer is we are investing in good times, bad times, in a very consistent way. And
Okay, so now, and we will in the end talk about what's going to happen, but I'd love to now hear, and I'll ask whoever of you to jump in on this one. I told you beforehand, if you want to go first, then tell me, because this one might be difficult. But in the current market, what contrarian thesis do you have that, and when I say contrarian thesis, I mean, what do you believe that will be an opportunity that is really ripe now for you to capture, that not many around you really, see? Because it's obvious to everyone that, okay, the market is cheap right now, so we're going to shoot a lot of capital up. But I'm curious to hear if you have, see anything in the current market that is different, and for that reason, you're ready to bet big on it.
Yeah, once we share it, it's not going to be contrarian anymore.
Nah, but that's a beautiful thing about being contrarian, right? Because you can say it as many times as you want. Everyone just shakes their head and says, this guy's lunatic, right?
I think maybe it's not entirely contrarian, but I think there will be much more opportunities at the pre-seed, and I think we should deploy much faster at pre-seed. And referring back to speed, I think there will be a lot of operators leaving startups, like senior, very strong talent, etc., because the opportunity cost is much lower, because the ESOP in some cases unfortunately becomes worthless. So yeah, I'm not sure this is a contrarian statement, because it's kind of logical, but in a way I think it's a little bit overlooked, and I think in that specific case speed can be of essence, because obviously for strong operator talent turned founders there will be demand. So just one observation.
Not sure if it's contrarian, but I have two. I think we invest with a lot of angels, and I think it might be contrarian for some of the angels that we co-invest with, which is there's no way we're going to time the market. So it's about keep on doing what we've been doing, and I know that eventually, sooner or later, the investments that we're executing now or in the near future will yield amazing results, because the way the market behaves, it is an amazing time to be investing, and it's also for all the emerging managers out there, and we are emerging LPs. It's a great moment to just keep on doing what you're doing and become part of the furniture of venture, right, in Europe. And that is an amazing opportunity. I don't know if it's very contrarian.
No, I actually think so. So that part is, if I should say anything to the audience here that are not very much knee-deep in VC space every day, there it's very contrarian, right? Because we're hearing many funds that are struggling to raise, because the contrarian view in the LP world right now is, I actually dare invest into VC, and because many families are pulling back.
Exactly. And some angels as well, and some family offices as well. Then the other one, which we have at least one person that I know in here that is seizing that opportunity, which I think is super interesting, is the secondary space in Europe. Not only on startups, but also on VC funds themselves. Like GPs are struggling. GPs are struggling to come up with a commit for fund 3, 4, 5, 6, whatever. And I think there's a humongous opportunity for any LP out there with the maturity to do it. Not us, but someone.
I'm not sure I have too many contrarian thoughts right now on this. I might have one. So when we started fundraising our Fund 4, which was end of the happy time, end of 21, we actually sort of drafted a little bit of a contrarian thesis there. which is very much in line with the smaller size of the fund, and that was doing less follow-ons.
Yeah.
Originally, in 2021, the reason actually was that there was so much capital that follow-ons were not necessary, and sometimes even hard to push through, right? So even though it was contrarian, it made a lot of sense. But in the changed market, I think we might actually stick to it still.
Yeah.
Looking at
if I could just add to it, because that's a very good point, because what we were seeing was that every single company was getting that follow-on funding, and that meant that you weren't really, you want to go from pre-seed to seed to Series A at a higher and higher valuation because you're taking out risk, but you weren't really, right? Because you're just getting another round. So just to put that in there, that's the dynamic that you just spoke about, that, well, there was no reason for you to pay a higher price at a later round.
And the funny thing, when we were discussing last year about Fund 4, and we were discussing follow-ons, the funny part was we realized that in VC, there was a general understanding and consensus that follow-ons are good for the economics of the fund.
Yeah, I always
do your math, guys.
Yeah, I always
They're not.
That. No, yeah,
they're not. And also the concept of de-risking via follow-on rounds.
Yeah, it's ridiculous.
Not true. Actually increasing risk in a way. So that would be my contrarian thought.
Now, it's incredibly funny.
It's not true. It's also not true.
Okay, let's dig deeper.
Please.
I'd argue it's not true.
No, in the sense it really depends of the portfolio strategy you have.
It does.
So you
yes,
have,
of course. Of course.
It depends how wide you cast the net and what is the strategy behind that, and how early or how late you're getting it.
It is
That's what I mean.
also, it has a certain requirement on the initial ticket if you don't plan for many follow-ons.
Yep.
And then there's this ever overarching question of, so you do not support your portfolio companies? Well, we do, but you have to think of it that way.
Yeah.
Instead of, we're pushing as much money in, if possible.
Yeah.
That's not the right approach.
I'd actually now talk a bit about that follow-on strategy, right? And maybe more, because it's one thing having a strategy, which is, oftentimes we think of that as a portfolio model that tells you how much you invest, right? But more, what is the decision process? Because that's the tough thing, right? If you have many funds say, well, we make it a consensus decision on following on, and then it's actually the same group that I also invested in the beginning and who are close to the founders and so on. I think what I like the most are the funds where you have a team that does the initial tickets, and then you have an almost siloed team that does the follow-ons. And you don't get a follow-on unless this person says okay on it, because that person is the expert in Series A and doesn't know the founders, doesn't know shit. You need to convince that person. I'd love to hear your take on that.
Well, we need a bigger fund for that. So we might do an extension there.
As I said, we were able to provide our portfolio companies like only the best ones with the follow-ons. But I think we did something which was very similar to your idea, because for every company which has some follow-on rounds of investment, we are launching the syndicates, syndicates of angels. And it's actually a very good thing how to prove the performance and traction of the startup by the market. Mm-hmm. So this is what we do, and some of the follow-ons are very successful, some of these not.
Yeah, I think it's very different. Sorry. Depending whether it's a push or pull case, right? Because in case that the company is struggling, not to the extent that you don't believe in it, but obviously your ticket can give like very strong token of confidence in the company and improves the outcome because it manages to raise. Whereas for the in the push case, depending which perspective, but of course, if you want to squeeze as much cash in, not in all cases it's for the benefit of the company, to be honest, because you kind of limit the scope of new investors coming on board and smart board members that the company can get. So this can be actually negative outcome. I mean, maybe positive for the VC, but we try to limit that to an extent. If there is somebody else joining the round that brings value, then it's okay to just do pro rata and not push for super pro rata, even if you are super bullish about the company.
I just wanted to say that I thought about your idea of detaching the two teams, and I don't like it. So I think what you lose there mainly is the intimate knowledge of the company, the space, and I would not want to lose that. So you might gain some sort of independency and get rid of the bias, but you should aim for that anyway, right? So we as VCs should always, because we do have fiduciary duty, we have other people's money, we always should look for unbiased views. And sometimes we're succeeding, sometimes we're failing, but I wouldn't want to lose the unfair access to...
Obviously, yeah. And that is actually the next thing I would then ask you about, which is, I have always hated the VC stance where we don't do follow-ons unless there's a price round by a third party. Okay, so that means
shit.
Yeah, that means you just gave away your opportunity to get in at a lower price than everyone else.
Yeah, I don't like that position, and I don't like... We don't do follow-ons, full stop. That's not a partner you want to work with, right? Yeah. VCs should support their portfolio companies in good times and bad times. Yeah. That would be my take.
Any takes? Otherwise, we will go to what is going to come.
I actually wanted to... I would love to hear thoughts around bridge rounds as well, especially over the last year or so, because we saw more. How do you guys think about that? It's not follow-ons, but it's more capital to the same startups.
Yeah. Thanks.
They exist. That's what I think. Yeah, bridge rounds do happen, guys. That's what we've seen in the market. It's a bit of wisdom.
Thanks. See, that's why we didn't want to talk about what you're seeing in the market, because then we get stupid shit like that. Michael,
I guess we all do bridge rounds when it's necessary. Yeah. Sometimes we...
No, but so it's not... I don't think it's whether you do it...
Most of the times we hate them.
Yeah, of course you do, but...
Kind of.
But what is your process to think about, okay... Because that's
the
big
kind
question,
of.
Right?
And that is the interesting part of that sentence, right? We hate them, kind of.
Kind of, but because we only should be doing them if we're still bullish and we believe that the substance is there, that we know something the dumb guys around us don't, and that's why we do bridge rounds. Bridge rounds to rescue the company which we lost trust in, we shouldn't be doing, and we try not to. We almost never do.
So I'll now go to the what is going to happen question. And Michael, you're about. So I'll let you start. What do you think? If you should say one thing that's going to happen that you really believe this is where we're seeing the market. And I think after 5 replies to that, we'll get to a point where we know everything. And since David is my partner, I'll ask him to go second so that he doesn't get the tough one. That will shoot to Ondrej.
It's good that you haven't asked this question like a year ago, right? Because then I would say we all would be very wrong about many things. I think we haven't hit the bottom yet in general, but I think the uptick to normal times, and by normal times I don't mean 2021, but previous years, I think it won't take longer than maybe 2-3 years maximum. There is still fundamentally a need for innovation, and there will be pull for that. It's just the models which didn't make sense and a lot of herd mentality that has impacted us in recent years that has led to it. But in fundamentals, I think we will be back soon to healthy ecosystem. So I'm an optimist, I guess.
But in 2 to 3 years, not in 6 months, and not tomorrow.
Yeah.
So David, I'll ask you so I don't put you on the spot in the end.
No, but I think, honestly, I think what we'll see, I agree, but what we'll see is Europe will continue outperforming the US in venture. And I think that is an important message to keep on hitting. And I think a lot of that will also be driven more and more by Eastern and Southern Europe. And I can only hope that investors, angels, smaller family offices, less institutional investors into the asset class see that more and more, so that we don't have them flocking to the big US names, but flocking to the now emerging European GPs.
Amen.
So Ondrej, I won't
Should
ask
I go
you
with,
about, no, you're the last one to spew your whatever you've got on your tongue. Michal, let's go to you.
I had this question, so I think we have in front of us some crisis it's based on very basic economic theory. So there is high inflation. We need to pull the money from the market back, and it's connected with some recession. But the question is how it how does impact the venture capital market in the pre-seed stage. And I think that for us, there is no change.
Yeah, interesting. Vuk?
So, as probably you might saw when I was talking, I'm really bullish about emerging VCs. So I really think that this, as in prior years and prior crisis, I mean, this will be actually a good time to invest in them, because not a lot of people will go out currently in the market or in the next couple of months really to fundraise, because it was always tough. I can expect that it will be even tougher in the next couple of months. So really people who are specialized, investing early in things that other people are afraid of, I think these will outperform in the long term. I'm not sure about the region. I hope that CE will good. I hope that Balkans will also do good. But I think Europe produces these people, either founders or investors, and we will continue to see it. I'm just not sure, how long it will take to get there.
Ondrej, lay it on us. You've been sitting there with a face that I don't know what says.
Me neither. Me neither. It's still a bet what I'm going to say. So, I don't know. Historically, bear markets lasted 289 days on average.
275, I think.
No. I'm pretty sure about that one.
Okay.
Your stats are crooked. Fake. So, and we've been in the bear market for what, 7-8 months. So, okay, probably not in the fall, but I'm a big believer in the cycle will turn in 2023, not 2-3 years.
And what about
this being recorded?
Yeah. But we only publish it in a year. So,
so I believe that's what's going to happen. I think the U.S. will recover before Europe, and I do see many additional challenges for Europe, including some nasty political things in certain markets. I am, of course, very, very bullish about Central and Eastern Europe, but I'm afraid that it's going to take a little longer. I'm pretty sure Putin will die, and it's going to be a lonely and ugly death, hopefully painful.
So that's where the faces came from.
And I was imagining, I was literally killing. And November.
So that's where the faces came from.
And I was imagining, I was literally killing. And November 11th, I think, is Wakanda Forever premiere. MCU fans.
Of course. I loved it.
Great. I think that was the very positive finish of this panel discussion. So, Ondrej, thank you very much for that, gentlemen. Thank you.
Thank you.
That was it.
Thank you.
Thank you for listening to this episode of the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at EU.VC.